Well, thank you everybody for joining us. My name is Dave Shasta. I'm going to be moderating today. The star of the show today is Ema Casanova. We've also got Joe Foster, longtime VanEck, longtime gold strategist here at the firm. And we've got a guest as well, Charlie Cameron from our hard assets team. He's also been at the firm for a very long time. And we're going to jump into gold. So Andrew, let's move to the next slide here and get it going. So starting with gold, big picture. I couldn't possibly imagine a more optimistic scenario for this asset class, right? We've had persistently elevated inflation for some time, big government debt, right? Big government spending, seemingly no end in sight. And now we've got Trump effectively amping everything up with trade wars, and that's leading to increasing recessionary fears. So you put all that together and you're getting accelerating gold prices. Now, here's the cool thing. Gold equities significantly outperforming gold bullion finally, right? So as we sit here year to date, gold equities up, over 50%, over 20% on top of gold bullion. So certainly an interesting time for gold equities. And why are we talking today, right? There's proven expertise here at the team. So that's the focus. It's going to be Ema and Joe and their team on the opportunities available within gold equities. So if we can go to the next slide, please. This is what the team looks like. So you've got Ema there up on the left. You've got Joe Foster. You've got Adam Graff as well. Adam's unfortunately not with us today, but Adam's a member of the team. Who am I? Why am I talking to you? So multi-asset solutions. We manage assets across different asset classes. Big fan of gold as well. We allocate to gold everywhere that we can as well. So happy to be invited here to help moderate this. Moving to the next slide, please. So experienced team, broad opportunity, proven results. This is a team with over 30 years average investment experience. Cool thing is that they have backgrounds in geology, engineering, financial markets. So truly diverse, talented team. The opportunity set. When you look at gold equities, you've got differences in market cap, or you've got seniors, mid-tier, junior producers, junior developers. You've got royalty companies and even the opportunity to buy bullion. So there's a lot of different ways to access gold. Clearly a great asset class for active management. Moving to the next slide. So a macro perspective, and I only have a couple more slides here before I pass it over here, but I just wanted to tee it up a little bit. When we say a macro perspective, so Jan VanEck, CEO of our firm, he talks about our shop as a macro shop. Why is he saying that? If you go back to the origins of our firm, the founder John VanEck started the firm with a pretty big idea. So when you think about macro, what are we saying? Really, what we're saying is, what are the big ideas likely to shape the markets over the next 5, 10 years out? And the original big idea was pretty simple. The United States in the 1970s, in the late 1960s, was spending way too much money. So it was very obvious, at least to him, not to most, was that the US dollar cannot be supported and backed by gold. It wasn't sustainable. And effectively, he was right. So he invested in gold equities. And when gold became unpegged and was stopped being fixed at $35 an ounce and free floated, the price of gold equities went through the roof. And that was the original big idea. And now we stand here in front of you today with gold as our big idea again, right? So this is kind of round 2 for us on gold, because like what I said in the beginning, right? Lots of inflationary pressures, lots of geopolitical tensions, hot war, right? You got Cold War, you've got increasing political tensions, and now you've got recessionary risks. You put that all together and you're putting us on the path, or the world's on the path of de-dollarization, putting gold more in favor. So gold is, from a macro perspective, definitely a top idea for the firm. If we can move forward, please. So, and I'll leave you with this. So when we look at gold right now, we're sitting here at $3,400 an ounce. Gold is the top performing asset class over the 1 year, the 2 year, the 3 year, and the 4 year, and soon enough it'll be the 5 year relative to the S&P 500. So looking at the S&P 500 versus gold, you've got 42% of outperformance year to date. 1 year 38%, 2 year 43%, 3 year 51%, and over the 4 year periods, gold's ahead of the S&P 500 by 57%. These are really big numbers. So when from an asset allocation perspective, why does this matter? Everybody should have an allocation to gold. from our side of it, at least a 5% allocation of gold from a diversified asset allocation perspective. So we want to see everybody invested in gold. And I'm going to pass over the mic to Ema now. And Ema is going to talk about why gold now and specifically why gold equities. So Ema, jump on in.
Thank you, David, and welcome everybody to our webinar. The timing couldn't be better, I suppose. Overnight, gold hit, touched to 3,500 briefly, and like David mentioned, here we are around 3,400 level, which even for me is a bit shocking. But it's great to have David introduce the team and moderate this webinar. He has done and continues to do a lot of work in how gold and gold equities fit in a portfolio more broadly. And so I do refer you to a lot of his research, which just solidifies the case for why every investor should have some exposure to gold as an asset class. So today we're going to talk about what's happening in the gold markets. And the number one question, are we too late? What's next? That's what's in investors' mind, given the phenomenal performance that gold and gold equities have had, especially this year. So let's go over some of what we see as the important drivers and what happens from here and some of the important dynamics that we see in the sector. We start with that gold surging price chart that we had, Andrew was flashing there for us. And, Andrew came up, our product manager came up with this slide. And, it does bringing in the time that it takes to reach this $500 increases. It tells story in that for me, it highlights just how things have changed for gold, in particular for the commodity, as far as what's driving this, what's causing these moves. The slower cycles, the longer periods to reach new levels. It's sort of what we're more used to. But I've been highlighting this over the past couple of years that we have experienced a historical shift in gold demand and gold price trends, and that we are now, we have another player in the gold market, which is the official sector. And that has created a significant shift and a change in how the gold price is reacting. I think the behavior that the sharp increase going from a more moderate increases to this almost violent rally that we've had this year, but even in some portions in 24, you see this steep line in 25. But if you look at, May, June through October of last year, it was also a very strong slope there, a very steep slope in the gold price. And I think it's the best way, I guess I can explain it is we've got what has been historically the large drive of gold prices, investors, investment demand, teaming up with the official sector to create the response we're seeing here. If we look at the next slide, I show, we cover the central bank, and this is not a new slide. We've seen it. Actually, can you move to the next slide, Andrew? I wanted to highlight first this. This is what we're saying. You see the doubling in investment in official sector buying, net buying that happened in 22, 23, 24. We've covered that extensively, so I won't go over that. But clearly, what we've been seeing is that being the large driver. And we see 25, those are the figures for 25 on the right, showing this is not going away. This is a trend that is here, it's here to stay. We expect to be here longer term, and clearly the recent developments over this 2025 with everything that David highlighted as far as what's happening globally, war, tensions, geopolitical tensions, trade wars. This is only going to make the case for central banks to continue to diversify their reserves. So we see that intact. Now, what had been lacking over this past few years was investment demand, and that's the slide that we had there previously. And Now we see it, and I highlighted that period in 24 where we saw some investment demand pick up in blue. And then again, in the first few months of this year, we see basically the return of the Western investor. To be clear, Asian investors have been right alongside central banks doing a lot of the buying in the past few years. But more recently now, like I said, we're getting the double whammy, basically. We're getting the central bank, the official sector buying, and then we're getting investors saying, okay, maybe it is time for us to buy as well. And I think it is this combination of two now and decisively very strong centers of demand combining to give the gold price reaction that we're getting. So that to me explains why we're seeing this strong response. If we go to the next couple of slides after the central bank, this is the gold price chart. So now everybody says, and that's we received some questions ahead of the webinar. It's like, am I too late? Can I still add? And so our answer is yes. We're very bullish, very constructive on the gold price going from here. And I'm going to tell you in a bit why. Now, when you look at this chart, it's natural to assume, okay, yes, the gold price rises, and then there is some periods of consolidation, sort of sideways trading that takes place after a significant move up. And honestly, I've kind of been waiting for that period, just sort of imagining that past cycles would would inform what this cycle is going to be like. And the more I look at this, the more, now what's the next resistance? Like I said, we touched 3,500. We're sort of uncharted territories, but yet I think it is, I think, constructive to assume that perhaps we will have periods with some pullbacks in the gold price that are more reflective of period cycles. Now, I go back to why this is uncharted territories, because we had never had this dynamics that I explained before, where continued and strong and perhaps getting stronger central bank demand is combining now with the obvious need for investors to also diversify their assets and portfolios and go to gold. And so do we enter another range? I think it's worth mentioning that we could enter another range. Obviously, this range is going to be at a much higher level. And what's really attractive is this, whatever that level is, it's very attractive for gold miners. And, that's what I also want to spend some time talking and about. But
Emma,
I also,
can I add one more
sure,
thing while
sure.
you've got this slide up?
Yes, please.
I'd like to point out that you see the chart there, and this bull market that we're seeing is not the result of a crisis. I mean, we have not seen, if you think back to the financial crisis or the tech bust, those were big gold drivers. We have not yet, at least, seen a crisis, yet we're seeing this almost parabolic move in the gold price. I think everybody on this call would probably agree there is the potential for another financial crisis or some sort of global calamity. And maybe that's the end game of this tariff action. But as far as gauging where the gold price is going from here, where we've come so far is in the absence of any major crisis.
Thank you, Joe. And yes, and the reasons why in a backdrop, like David and Joe have explained, we still think there is, plenty of reasons for investors to want to jump to gold as a safe haven. The next slide on the deck there just shows the relationship between what we see as investment demand. Our proxy for investment demand is ETF, bullion, gold, ETF holdings. As a reflection of that investment demand, that is how a lot of investors express their desire to own gold. And we've highlighted extensively as well, and as you can see there, the breakdown in the relationship between holdings and the gold price. We sort of explain that with the official sector stepping in and filling that void that the investors left. And what we're seeing now is obviously the investor coming back, that relationship become into holding again. And one of the reasons I'm so constructive on the gold price here is to just looking back again as a reference. And again, this is different, so maybe things get amplified as to what the correlation here is between increasing gold holdings and the gold price. But the point I'm trying to make is, look, yes, we've seen a surge in investment demand more recently. Clearly, I think holdings are up 7% or so year to date, but we're nowhere near peak levels. There are reasons why investors should want to look to gold and gold equities, but we're not. This isn't a crowded space. Not everybody's in it. We hold a lot of meetings. We meet with companies, and clearly, yes, there is more interest. There is obviously an increase in demand, but we're not. This doesn't look overbought to us. And you look at peak levels of demand reached in investment demand back in 2020. And I do very simple math, nothing crazy, but if that same correlation were to hold, and going to those peak levels from where we're now would translate at least another $600 move in the gold price. And so that's what we say, from where we are here, it's easy for us to see a path to 4,000 and well beyond 4,000, of course, as you add on additional demand, which could come above those peak levels, and not to mention the support that we're now getting and the driving force of the official sector behind those purchases as well. So yes, could we have a pullback from here? Clearly, especially after such a strong move, but we see a lot of protection on the downside and a lot of upside from here potentially. And this is great, obviously, if you own bullion, but if you own or are looking to own gold equities, there is even more reason to get excited. And that's what I want to spend some of the time talking about. This is a chart. I know it's a lot in there, and I think I showed it in the last webinar, so some of you might already be familiar. But my thesis, I guess, is that the reason, because that's also another question that comes right away. It's like, great, Emma, gold's going up, everything's great, but guess what? The equities have lagged quite a bit. So how do you make a case for gold equities? I'm almost kind of discouraged from owning gold equities if I look at recent performance. And the point I'm trying to make here as I talk about who is driving this gold rally is that when investors are behind it, when we do have investment demand backing the gold price action beyond official sector demand, guess what? The equities do what they're supposed to do. And so I highlight different periods where, the gray bars, negative gray bars there are periods where the investment demand decline. And you see that gold equities couldn't manage to outperform the metal. And that was true in 23 and in 24. But here we are in 25, as we were in all those other periods I highlight on the left. When we see an increase in investment demand, guess what? The equities are doing precisely what we expect them to do. And this might be oversimplified. There are reasons, obviously, fundamental to the gold equities that justified perhaps some of the underperformance in recent years, the risks, etc. But I do think, in large, the underperformance can be explained by the fact that there was no center of demand for gold equities like there was for gold. Official sector stepped in and started buying gold. Nobody really stepped in to fill that void for the gold equities. As we get investors back into the equation, then we see the response. And, this is still holding today. The other point I want to make with respect to outperformance is that, I wanted to make a point that I forgot. So let's move to the next slide. Maybe if I look at my notes here, there was another point on outperformance of gold equities. I'm sure it'll come to me. But anyways, this just shows it's coming from all across. And the strategy, the strategy should be to own a basket of gold equities. That's another important point. I know it's had a lot of questions. Okay, so you're telling me I should participate in the gold equity market. How do I do this? Do not try to buy single stocks. We have approaches. We have mutual funds. We have index funds. We should be looking at a basket solution. There are a lot of risks involved in investing in this sector. Shazler highlighted the team expertise that helps us manage these risks and helps us diversify a portfolio to be able to manage this risk. And so what we show here is the different categories, the smaller companies, the mid-tiers. We put the royalties separately because they're different business models. They're not producers, they own interests in the companies, in the minds of other producers. And then of course your measures. But what we want to show is this year, as the stocks respond to the leverage that they carry in a rising gold price environment, we're seeing all of the sectors perform in tandem. And that's what you expect. You $300 move so far this year in the gold price translates into a much larger margin increase for these gold equities. And it's the reason you own gold equities, to realize that leverage. Clearly it works the same way on the way down. But in this environment that we're in, as when we expect rising gold prices, considering that the equities are coming from lower levels, considering their underperformance recently, not just relative to the gold price, the metal, but also historically. I think some of the charts that we have there show just basically where these equities stand as far as valuations and other fundamentals. If we can flip to the next slide. This is just a snapshot of the universe, small universe. Another reason when money and capital starts to flow into this sector, you do get very strong, quick reactions to that money inflow because it is a relatively small space, 600 billion market cap today after the recent increase in stock prices. But that just gives you an idea of the sector and how it we classify it depending on how much gold is produced, and then obviously for some of these companies that are not even in production. But I think there's a slide there, Andrew, on some of these multiples. One of the questions I always got asked as far as, when I've been saying we need the Western Investor Pack for quite some time now. And the question was, well, what does it take? And I think it takes an environment like we're seeing today, where obviously equities, broader equities are pulling back, and investors, the need to own gold, which is obvious to us long term. And that's why we think gold should be a permanent allocation in your portfolio. But the more immediate need obviously arises now, and investors will. And that reminds me of the point I wanted to make before as far as performance. And it is that when I do these webinars and I talk about gold and its role, it's really it really helps me get my point across, and it really backs our case. When we have a period like we just had in this first quarter and this last few weeks of turbulence and uncertainty and heightened volatility in the markets, we stress that that's when gold comes to your rescue. That's why you have it in there as portfolio insurance, as a diversifier. It enhances risk-adjusted returns. And so when we have periods like this, or the banking crisis in 23, or the pandemic, or whatever, you expect gold to do what it's supposed to do, and in this, and gold and gold equities. And so here we are yet again in a period where if you own gold, you would have expected, that it came to protect you, and it did. And so that's the point I wanted to make as far as performance, that this first few months of the year, once again, reiterate gold's long held and proven track record as a true safe haven. And for the gold equities, obviously this gold price is helping, but the chart that we're showing now is, it says it's not just, oh, gold equities are going to do great because the gold, price is increasing, and so they're going to, their margins are going to expand. True, clearly there's going to be a lot of free cash flow generation here. I looked at the average price so far year to date for gold. It's up 2,900. That's a significant bump in free cash flow generation for all these producers. And as this, especially relative to the broader markets, but overall for this industry, it's at levels that we had never seen them before as far as health. So here we have some of the multiples, enterprise value to EBITDA, comparing, 2020 to 2025, and the obvious and gap there between the S&P and the gold miners trading at much lower multiples. And so debt is under control. That we could show debt to ratios as well that would look very attractive for this sector. Dividends are increasing. Companies are putting a lot of these free cash flow to work in share buybacks so that they can further return to shareholders. Growth is being carried in a disciplined way. And I know you've heard me talk about all of these things, but I'm reiterating to say these companies are remaining disciplined. I think a lot of investors, and naturally so, think, oh, the gold price is going to increase, but these companies are just going to, start spending more, and they're not going to do it in the right way, or costs are going to increase and keep up with the gold price increase. What we're seeing is, yes, costs has definitely increased in recent years, but the gold price has more than offset those price increases. And today we see costs contained. So we do expect that margin increase to happen. And again, we expect these companies, more importantly, to be responsible with the free cash flow that they're generating. M&A is picking up as more cash and higher valuations are in play. But we're seeing this done in a very disciplined way. Companies are not just trying to acquire any asset just to say that they have more production or more reserves, and so therefore they should be worth more. When we ask these companies frequently when we meet them, what are you looking to acquire? Their approach is, we're looking to acquire high quality ounces that improve rather than dilute our portfolio. We want to grow, yes, but we want to grow metrics that are important, not just production. We want to grow returns. We want to grow returns to shareholders. We want to lower our costs. And so everything there, as a group, there's, obviously companies get in some trouble, companies that face some risk, et cetera. But as a group, as a sector, overall, the sector is looking in really good shape. And that makes us even more bullish, not just on the back of a higher gold price from here, but also on the company fundamentals. Let's see, what else do we have in there? And then just to close things up, I guess this is a good way to wrap those up. So here we are. This is all happening. Companies are in good shape. Equities look attractive. Gold is reaching new all-time highs basically every day for the month of April. And yet, this is not, a sector that is widely owned. This chart reflects historically how under-owned this asset class is. More broadly, I think the figure I have is less than 1% or 1% of global financial assets are allocated to gold. So is there room from here? Is there more investment demand that could come? Clearly, just a small shift in this allocations could have very large implications for gold demand, for the gold price, and like I said, even more so for gold equities as they re-rate in this environment. I am going to stop there. I think I made most of the points that I wanted to make. Anecdotally, I'll speak a bit about how on the back of this last slide, in talking to companies, it looks like they're starting to see some interest. I met with a large mining company, one of the largest mining company, reporting that for the first time ever, perhaps, or in a long, long time, they were meeting with pension funds in the US who have zero gold exposure, but are thinking they should have some exposure to gold equities. And we're starting to see indications that investors are clearly interested in gold, and gold as an asset class, but they're definitely not back or in full force yet. So I'll stop there, which is nice 30-minute pause so that then we can take some questions.
Ema, awesome job. Tons of questions. I'm going to attempt to kind of summarize what you said really briefly and then bring everything back together. You've got lots of engagement, so I think you did an excellent job. Maybe start really simple. You made a great case for gold. Gold's a top performing asset class. What I would kind of just say what you said again, which is effectively trust investors to do what they've always done, which is buy the top performing asset class. And you've got now gold outperforming S&P 500 by huge margins over the 1, 2, 3, 4, and only a few percent away from on the 5 year. So I think you made a lot of good points on that, and I would expect the Western investor to follow through and drive gold prices higher. So that was certainly a good point. On the gold equities, I think you made a lot of good points there as well. The outperformance is clearly there, expected to continue. And then I really like the chart that you showed as well about the differentiation across the different gold segments and the appeal for active management there. So certainly firing on all cylinders there from an active management perspective. Now, let's jump into the questions. You've got lots of them. Let's start with tariffs. So I know you hit tariffs a little bit. How specifically do you see tariffs impacting the price of gold, let's say, over the next 12 months?
Yeah, thanks, David. That's a good question. It was in my little bullet points here in my notes of stuff I wanted to touch on. So I'm glad it came up. Obviously, very topical. And before I forget, I'm happy to report Adam Graff did join us. So I'm sure he can jump in here and also help us answer some of these questions. But overall, the way we see tariffs, and this is a developing situation, so nobody really knows who is getting hit with what, but gold so far and silver and some of these metals are not included in some of this tariff talk. So from that point of view, the producers seem fairly isolated from some of these tariff impacts. However, depending on what happens here and how everything pans out, if this ends up increasing cost, input cost that are used by the producers, we could see, that hit their cost structure. Now, for reference, all of these companies there was pretty much consensus that about 5% inflation is what they expected in 2025. And I highlight this because that should be a number that we keep in mind. If we start to see inflationary pressures, that number could be higher for the producers of gold. Now, offsetting this, and depending again on how this all settles, we are watching foreign currencies. A lot of these gold producers, of course, are in their costs are denominated in the local currency. So weakening foreign currencies, it's a positive for the producers, which are getting revenues in U.S. dollars. So some of the impact, inflationary impact, could be offset with some of the benefits that some of these producers would get from weaker local currencies. Companies that are building projects could also be a little bit more exposed if their steel is more expensive, etc. But so far, let's just say we're not very concerned with the impact of tariffs on gold producers and their bottom line.
Ema, what about M&A activity? So has there been any recently? How has it impacted the sector?
Yeah, we've seen some a bit of a pickup. If you check out my monthly blog, I actually covered 4 different M&A transactions that happened recently. What we're seeing is consolidation that needs to take place in this sector. It is fairly fragmented sector. So we saw a couple of consolidations. Australia had a bit of a wave with uh, three companies acquiring three other smaller companies in what appeared to us to be logical transactions where the assets being acquired make sense in the new company. There are operating synergies, and we're seeing this, and again, at a scale that we think it's prudent and at valuations that make sense. And again, transactions that we see as value accretive rather than perhaps some of the past cycle transactions that tend to destroy value. So we're pretty constructive on the way M&As being handled here in what could be, a crazy time with so much cash flowing around. I don't know if Joe or Adam want to make comments.
Yeah, I think, more companies have come into our investment universe with the higher prices. So, and a lot of properties become economic at these gold prices. And it's no secret that when you look at production of the producers looking out, 5 to 10 years, there's you see their production start to decline. So I think a lot of producers will be looking to fill those holes in their production profile, and we'll probably see more M&A as time goes on.
Charlie Cameron's been on the call, but he's been awfully quiet. Charlie, do you want to, usually have something smart to say? You want to chime in and add anything?
Let's say, not sure if it's smart or not. The one thing I would look at when you had those charts of gold up, I think now it's central banks are cutting rates, the dollar is weaker, yield curves are steepening, and that's always been good for gold. The difference to me was like after COVID, when all the central banks were raising rates, yield curves got inverted and the dollar got very strong, and gold really never came off. It paused for a bit, but that's when it, to me, looked different. I think now you get why gold's going up, but in the 20s when they're raising rates, it was very, very different price action. And I think that's probably lead to maybe the acceleration that we're seeing now in what traditionally is a more gold-friendly environment.
So we have a question. So there's lots of questions that we're trying to get to as many of them as we possibly can. This one's about our brothers and sisters up at the north in Canada. So there's a strained relationship right now, obviously. And the question really is about operational hurdles related to the mining companies. So somebody from the gold team want to address that?
Yeah, sure. I mean, these companies own assets, the larger ones, obviously everywhere. There's obviously a strong mining sector here, particularly in Nevada and Canada. All of, most of our company are Canada listed companies. I'm not, seeing anything yet as far as the relations. I think it's early to say how that may or may not impact. I don't expect any sort of critical impact. What I will say in the back of this is what we're seeing is both US and Canada as, this, I guess, tensions and race for trade intensifies is the US and Canada both are becoming a lot more pro-mining. And so both in some provinces in Canada and here in the US federally, we're seeing the talk of fast tracking mining projects so that, some of these metals critical or some, and at times gold sometimes gets produced with some of this critical stuff, gets accelerated. So this more friendly and maybe mining stance from both countries as maybe relations become even more strained, could ultimately actually benefit the gold industry.
So there's two questions that are related to allocating. The first one is about a gold price target. The second one is it too late to invest? I'll take a quick stab at it and then pass it over to you. This is, I think our answers will be similar, but obviously always a bit of a differentiation in thought there as well. Gold price target by year end, 4,000, 18 to 24 months, 5,000. I think the risk of that is it happens faster. So I think maybe being too conservative on the timing, given how gold is exploding to the upside. Second thing is it too late to allocate? Asking if it's too late to allocate is basically reframing the conversation of, is it too late to diversify? I think the answer is absolutely no, it's not too late to diversify. If you don't have an allocation to gold, that's a big mistake. It's been costly, time to fix it. So that's my short answer on that. Emo, what do you got to say about it?
Yeah, I mean, I agree, with that broadly. On the I'll tackle the allocation part, and is it too late first? You've heard us say repeatedly, if you have zero exposure to gold, then it's never a bad time to own gold. And I think what's important is to maintain a long-term horizon in view here, meaning you don't own, I don't think you should own gold for today or for the next 6 months or the next 12 months. You own gold because you have, once again, become reassured that it does what it needs to do in the times when you need it and over the long term. And so the question of, is it a good time now? It's as good as it's ever been from a portfolio insurance and diversification perspective. And then if you look at our outlooks, then even more comfort in making an allocation now when we're talking about $4,000 growth potentially at the end of the year. I'm not saying that's my target. I had a much more conservative target earlier on, but clearly 4,000 looks very reasonable and achievable. And then, just based on the numbers I ran, give it another, we still have most of the year to go. Could gold rise another $600 per ounce easily from here? And on your longer term, I think it's not just people here at VanEck now floating the $5,000 mark in a year or two, but we're seeing, the sell side and banks come up with, much more higher targets than they ever had. And so, yeah, I agree with you, David.
This is a question about, oh, sure, somebody else jumping in?
I
Yeah.
think your outlook also has to depend on what scenario you're looking at. The safe havens historically have been gold, U.S. Treasuries, and the U.S. dollar. Well, Treasuries and the U.S. dollar are no longer safe havens. People are going away from those assets. Gold is really the last safe haven standing. So in that type of a scenario, also going back to what I said earlier, we haven't seen a financial crisis. If we have, I think we can agree there is a possibility, or put whatever probability on this that you want, but we could have another financial crisis of the same scope and magnitude that we had in 2008. Maybe different drivers, maybe different financial drivers. But we could very well have another financial crisis. And if we do, just look at the gold performance after the financial crisis. I mean, we could see gold prices much, much higher than what we've been talking about so far.
Just to put that in context a little bit, Joe's numbers. So in 2000, gold averaged $280. Central bank reserves are 1.9 trillion. Gold was about 10% of central bank reserves. The dollar was 72%. Fast forward to today, central bank's reserves are 12.5 trillion. Dollar is 58% of it, and gold's more than 25% of it. So this is people talk about de-dollarization, but that trend has been in place. And I would argue, like as Joe said, there's much less options now. The yen used to be a good reserve currency. It's been a weak currency. China, Russia, I mean, there's a lot less options now if you worry about the dollar and treasuries.
We have questions related to mining. So what's the all-in break-even cost of gold? And the second part of that is, are miners locking in these high prices right now?
All right, I'm going to let Adam answer those questions. He's got all the 100 models that we have.
Thanks, Emo. I'll just keep it general. I think the all-in sustaining cost average for last year was roughly $1,400 an ounce. As Ema mentioned, companies were expecting about a 5% year-over-year inflation. About 4% of that was labor, 1% of that was royalties. So now gold price has gone up significantly since they were making that estimate. So it's going to be larger than that 1%. And so, you can make your calculations there. I would say, though, that mining companies are bringing on overall more production and expansions going forward, which should help offset some of that cost inflation with higher volumes.
Changing gears a little bit. So you guys invest in royalty companies, and there's questions about royalty companies now. So just talk about the opportunity set for royalty companies relative to the rest of the segments within the gold market. Optimistic relative to the other segments or not? What are your thoughts?
Well, I really like the royalty and streaming business concept. And I think the way in my mind I've always tried to I visualize it, and I think it makes sense to explain to investors is royalty.
Maybe start too with what is a royalty company?
Yeah,
Just give us that.
sure. So royalty and streaming companies, as I think I very briefly mentioned during my remarks, they're not gold producers. They're almost look more like us, like a mutual fund, in that they own uh, a percentage of the production of many mines, and in some cases of many projects that are not yet mines. But they 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 generate their revenues from basically owning a portion. So if a mine produces a certain amount of gold, they get 20% of it, depending on the structure, and they're not exposed to the cost of those mines, in that they get the production regardless usually of what the cost of those mines are. So they're insulated from inflation for the most part, and it's one of the reasons why they're investors like royalty and streaming companies when we are going through inflationary periods. But they're also what I was going to say is they're sort of an in-between bullion and full-on producers. And then they obviously have the added benefit of being highly diversified. So, the larger companies have interest in 20, 30 assets, or hundreds if you count some of the non-producing assets. We're very lucky that Adam models all of those assets for us and try to come up with valuations for this sector. But it's one that we have we like to have in a portfolio. As I can say, if I'm an investor is obsessed in owning straight up equities, then at least own a royalty or streaming instead of a producer. We still recommend a basket approach, but it is a very solid business concept. Now, in a rising gold price environment, to be clear, because they don't have exposure to the cost side of the equation, they are not as leveraged to the gold price, and potentially they could lag the producers. But so far this year, actually, I think they're holding up quite well.
There are a lot of questions about bullion versus the equities. What is the right time if you were spending the next incremental dollar? I would imagine you're going to say the equities, but I don't want to put words in your mouth. But why would you pick bullion or equities right now?
You're probably going to guess that my answer is equities. And yes, I think in this environment, and based on where valuations are and where we see the gold price here, I do think if you have the risk tolerance to add to equities, you should be adding to equities here rather than bullion. With that said, if you're new to the gold sector, if you don't have any exposure in the gold sector, I think it is very natural to start with allocation to bullion. It's perhaps more comfortable to do that, but I would say it's going to be very difficult for any general investor to become really comfortable and knowledgeable on the gold equities. You might, form your own macro opinions and be able to come up with assessment as to the gold price. It's going to be very difficult to navigate the gold equity space without the expertise that we have in-house, which is, again, why I recommend a basket approach to investing in gold equities. So what's the right split in general? Probably a combination of bullion and gold equities. Where do I think there is more opportunities today? You're right, David. I do think gold equities are the place to go today.
Well, the questions keep coming in, and they're still tethered to the subject. So, for every $100 increase in the price of gold, what does that do to the cash flow of these companies? That's the first prong of the question. The second part: are these companies buying back shares?
Right. So the first part is leverage, right? And Adam can punch in for every company. It's a little bit different, and we have the ability to go, to run those sensitivities on move in free cash flow per increment in the gold price. But roughly is 2-3 times. It depends on average. If a $300 move in the gold price, that we've had year to date is about a 30% increase in the gold price. That translates to a much larger increase in margins, which is why gold equities are up 50 something percent today. So again, it depends company to company. What you need to keep in mind is the cost. So if we're at 3,000 gold, 1,500 cost, let's call it 1,500 all-in sustaining cost, that's a $1,500 margin. So keep that in mind when you do the numbers. With a $300, $400, $500 increase, the impact on that margin expansion. So that's all about leverage. And then as far as moves in the stocks, a lot of people also ask, like, if gold moves up 1%, what should the gold stocks do? It varies, of course, but historically, what we've seen is that amplified response in the order of 2 times in a sort of more classical cycle of 2-3 times the response for the equities. The second part of your question, now I forgot, was on
Yeah, so it was
Buybacks.
two. Yeah, that's sure. Adam, were you jumping in? Sorry.
Your second part of the question was buybacks, correct?
Correct.
Yeah. You want to go for that? You go for it, Adam.
I'll mention a few. I mean, Barrick on their end of year call mentioned a $1 billion buyback. Newmont, I think, indicated at least a $2 billion buyback. Agnico is buying back shares, and so a number of the largest companies, which have traditionally not done significant buybacks, are now looking at quite significant buybacks. I would say that for the larger companies, the average dividend yield, well, it's a little bit shifted now. I don't have the numbers in front of me, but was somewhere around 3% dividend yield, and they were maybe doing kind of a 1% or less than 1% buyback. And I think the buyback is definitely has definitely grown for the major companies, where they're looking at very similar to the dividend, the percent dividend.
Yeah, and I think investors should look at the combined return, add up buybacks with dividend yields. Everybody likes a different flavor, but net, it has the same implications to shareholders and to shareholder returns. What I would say is that I as much as I do like dividends, I think buybacks give the companies a little bit more flexibility. They can be more opportunistic. They can do more one quarter versus the other based on share price movements, which is not true of dividends. Once you put in a dividend, investors demand that you sustain that dividend. And so there is less flexibility, which is why I think companies are now combining both strategies.
We continue to get a lot of allocation questions. So the first part of this, and I'm going to continue to consolidate questions into multi-pronged questions. So the first part of this, we addressed this before, but I think worthwhile again, because it keeps coming up. The size of a gold allocation within a diversified portfolio. That's the first part of it. And then the second part of it is, how do you allocate vis-a-vis active versus passive? So ETF versus active solution. So I guess I'll start with by rehashing the answer before from an allocation perspective. If you don't have at least 5% in allocation to gold, regardless if it's in the bullion or the equities, we think that that's a mistake. So if you have if you have a 0 right now, change that 0 to a 5, right? So I think that's the starting point of this. Then the second part, Ema, I'm going to pass it to you. So if you were going to allocate to gold equities and your two options are a passive solution or an active solution, which one are you going to and why?
Okay, again, the answer won't surprise you coming from me, but I think the active solution is the way to go, and the reason I believe that is because I do this day to day. We're dedicated to this space and understand just the many risks that this sector is exposed to, and there's value in actively managing those risks and expressing conviction based on the degree. Every company has risk. Our job as active managers is to assess how good the company is at managing those risks, and how intensified or not those risks are for each company. It's hard to see a sort of market cap based approach compete with an active look.
Just to illuminate the risks that Ema is talking about, we look at political risk, geopolitical risk, environmental and social risk, operating risk. These are the things that we look at every day, and they're very prevalent in the mining sector. So you don't get any of that in a ETF. A passive fund just invests based on market cap and liquidity, without any regard to the risks inherent in these companies. So that's what you're missing if you're buying an ETF.
The questions keep coming in, so we're going to overtime. So if you have the time to stick with us, do it. But I'm not going to end it here. So let's just keep this going. So I like the questions; they're awesome. So here's a question that I like. If your view is right about how attractive gold shares are, when are asset managers, so investment managers outside of the gold industry, is going to see the opportunity and actually start to invest alongside you? When's that going to happen? When's it going to broaden out?
Yeah, I think we're seeing this is where we're at. I do see this as an inflection point, hopefully, for gold equities, in that there is a lot of capital that is going to have to find a home. There's a lot of capital that is going to have to come out of what are historically high valuations in sectors that are going to potentially be under pressure in the current environment. And that capital is going to have to go someplace. And the gold equities have the benefit of being equities. And when equity investors look to where they can go find growth, and where they can find a re-rate, and where they can find expanding rather than contracting valuations and multiples, the gold equities are going to be, a screaming buy, in my opinion. So I think that this is last few weeks and months are the beginning of that that generalist investor finally taking a look at gold equities in this environment as a place to shift and rotate capital to.
Now you've got questions coming in from people that are already allocated to gold bullion, and they want to know if they want more upside capture right now, and they want the gold boost, as they say it. Do the equities make sense at this point?
That's maybe what we should call the gold equities, gold boost. That's exactly what it is. We use the word leverage, we use the gold beta, but that's exactly what gold equities give you. Let's be very clear. They give you that, like everything in life, there's no free lunch. They give you that boost while you assume, some risk. Um, but yes, the answer is very simple. The gold equities are the gold boost to your gold asset allocation.
Now you've got questions honing in on history. So the questions are really around the idea that gold equities are working awesomely right now. Cool. But there's been periods of time when they haven't kept pace with gold bullion. Why is this time different? Why should we expect it to be different going forward? It already has been, but why is that going to continue?
Right, and I'll talk briefly here to just sort of reiterate what I think I said in the call, which is we're seeing a very different sector. I've used the word transformed sector, but I've been using that now for 5-6 years. It's that transformation happened, and what we see is a sector that it's not letting the higher gold price determine how they run their business. Yes, ounces that are not profitable at 2000 or $1,800 gold become profitable at 3400, and that's what Joe was saying. There are more projects, more companies, because some of these gold can actually now economically be taken out of the ground. But with that said, companies are not rushing to price in 3500 gold into their mine plans or reserve or resource assumptions. They've remained conservative, which to me is an indication that they are they've learned from the past and are learning to navigate the cycles in a way that reassure investors that this is a sustainable business. This is not just a business for when gold is going from 3,000 to 3,500 in a few months. This is a business that will consistently generate good returns through the cycles. And everything I see as a sector indicates that that discipline is there and that the sector is in good shape. Joe, do you want to add something to the contrast of this versus previous cycles?
Well, if you look at the mistakes that management have made in the past, the big ones, one was in the 2000s, they blew out their hedge books. A lot of these companies had just massive hedge books, and they were offsides, and it cost them billions of dollars. And the second one was after that bull market, they took on way too much debt. And, if you're looking at like the 2011, 12, 13 period, a lot of companies were violating their debt covenants as the gold price was falling. There's virtually no hedging in the sector anymore. Balance sheets are very healthy. Most of these companies have net cash on their balance sheet. So and they've learned from past mistakes. So it's a much cleaner, much stronger, financially stronger industry than we've ever seen. And on top of that, we have these fantastic gold prices.
You guys want to talk about silver? We've got 3 or 4 questions in the queue on silver, so can't be ignored.
Sure. Silver, we view silver like gold. It's a precious metal. It's, I think, usually right with gold. What we're seeing more recently, the past few years, and even this year, is that silver has been lagging gold. That actually has sets up a bullish view on silver, because we think at some point that gap closes and silver starts to outperform to catch up with gold. I think that the underperformance, especially in this environment, is a reflection of silver's strong industrial demand component, which gold doesn't have. Gold is purely a financial asset. There is some industrial pieces, but it's minimal versus silver, which on the back of expanding solar power generation and other uses, it's tied to what the economic outlook. And so that could be impacting silver from here. But again, with a silver to gold ratio or gold to silver ratio of about 100 or so today versus historical levels closer to 65 or 70, there is reason to be constructive on silver if gold keeps on this path.
Just
I'm
to
gonna-
jump in, just to
Sure.
jump in there, Dave, also, I would think, you know, when gold rallied was purely on investment demand, silver was kind of the turbocharged one. Central banks really don't use silver as reserves, and this gold rally has really been central bank led. It's really investors coming in now. So because they don't hold it as reserves, if the investors get involved, I think silver will get involved.
So now, this is another asset allocation question. It's about to do with the correlations between gold, the dollar, rates. I'll take a stab at it first, and then we could pass it around. My perspective on this is really simple. In a benign period of inflation, in a period of manageable debt, in a period of normalized geopolitical risk, certain factors dominate the price of gold, whether it be the dollar, interest rates, et cetera, and that's fine, right? But you get into an environment like this, where you've got persistently elevated inflation, geopolitical risk that most people haven't seen in their lifetime, unsustainable debt, spending, et cetera, and you get this tinderbox of all the things that drive gold prices higher. Well, that's what matters, right? That's what matters in this regime, and those other factors in those benign regimes dominate, and they don't dominate in this regime. So that's why you could see a strong dollar, weak dollar, gold rising, right? Higher rates, gold rising. So that's my thoughts on that, but I'll pass it over to the crew and see what everybody else has to say.
Historic,
No takers?
I mean, the best gold rallies are when it rallies in every currency, and that's exactly what you're seeing right now. So this year, the strongest ex the Russian ruble, which I don't count because that's not even a traded currency, but Swedish krona is the strongest currency this year. It's up 16%. Gold's doubled that. So it's up in every currency, and those are the best gold rallies.
All right. Well, I think we've addressed most of the questions here. We've consolidated a bunch of them, but we got the core of the questions. Ema, today was your show, so I'm going to allow you to have the final word here before we sign off. So what do you want to leave everybody off with? What's your one consolidated statement you want to leave everybody with?
I think my consolidated statement is if you don't own gold, it's not too late to add gold as an asset class, and that should include gold bullion and gold equities. We see sort of the perfect storm for gold today, and it is not too late to join the party.
Well, this was a lot of fun. The questions were awesome. I think I enjoyed listening to the content from the gold team. So thank you guys very much, and I look forward to your guys' next webinar.
Thank you, Dave. Thank you, everybody.